ETF investors, pay attention because ETFs are under significant pressure. And since the summer of 2024, I've been indicating that ETFs might be overvalued and could potentially experience a major crash. In the past week, many declining trends have become visible, and now the question arises, is the stock market going to crash significantly? Of course, no one has a crystal ball, but there are a number of factors and facts that suggest it could be a tough year. I've been saying this for a while, but it takes time for it to become visible. It's also possible that good news could emerge and the markets could rise again. But still, there is a very interesting trend because for a very long time now, certain shares, the so-called blue chip stocks of larger, boring companies, have fallen dramatically. While technology stocks and growth stocks have continued to rise, but recently we see much more of a shift towards gold, for example, which is increasing in value. And other markets are falling very much. Only gold and defense ETF are actually doing well, and the rest is starting to fall sharply. And now, of course, the question is, what can you do well? First of all, one thing, don't worry, it's just money, and ETF are essentially a long-term investment. But still, I think it is very wise to position yourself because if the market goes down, of course, opportunities arise. And who knows, Trump may continue to do crazy things and nobody really knows what the consequences will be. And it could very well be that Trump is the trigger for this entire market decline. And if that happens, you'll be in a position to take advantage of it. In this video, I will share with you a number of ETFs that I'm currently following, which I previously sold but might want to buy back later if the decline continues, and a few other interesting ETFs that you might also want to follow. And of course, we're also going to talk about the overall strategy to position yourself for this. But be careful, no one has a crystal ball. The market could very well start rising again, so always think in terms of probability or opportunity assessment. Because we're going to take a look at the ETFs and my own ETF portfolio. First, head over to our website, Happy Investors, where you can download free booklets, including a free book about investing in stocks, as well as a ready-made book on ETF investing that includes 3 ready-to-use ETF portfolios that you can easily copy, and with which you can build long-term wealth. Because the goal of Happy Investors is simple, investing for financial freedom. And basically we specialize in stocks, but ETFs are very practical for everyone. They're accessible, inexpensive, simple, and you can still achieve some higher returns here and there. Perhaps thanks to this video, let's take a look at the ETFs. Recently, the market has risen a lot, especially the S&P 500, which is an index of 500 American stocks. Of course, they also have sales worldwide, and there are amazing companies like Apple and Microsoft that are part of this. However, for quite some time now, I've been pointing out that the S&P 500 multiple, which is the price to earnings ratio, meaning the price in relation to the profits that companies make, has skyrocketed to a multiple of nearly 30. Keep in mind that the median is 15 over a very long period. So anything above 15 is relatively more expensive. And the basis is that, of course, there are amazing companies currently in the S&P 500 that generate much stronger profits with more sustainable competitive advantages than, for example, 100 years ago. That can sometimes be a bit contradictory, but a price to earnings ratio of 30 is quite high, despite the high potential future profits that may emerge in the future. But not only that, in correlation with inflation, the Shiller PE ratio has even risen to 36. This is actually comparable to almost the dot-com crisis, but also in 2021 when there was a huge crash for growth stocks, and it's now at the same level as it was back then. So there are a lot of signals, and not only that, the real estate market has been quite high for a while now. And of course, for example, Bitcoin, earlier it hit 100K, but it's now starting to drop significantly. And the crypto market is, of course, primarily speculation based on supply and demand. There's no fundamental value behind it like profits, so a crash or panic in the Bitcoin market will be even bigger than, for example, in the stock market. And those two go hand in hand because there is indeed a certain correlation, namely people and psychology. And then you also have Mr. Trump. Mr. Trump is coming up with a number of tariffs, his favorite word, and I don't think he really understands the complexity and the impact of all these measures he's applying. So it's really very difficult. So before we talk about market timing, there's an important lesson first. You never know for sure when the market is going to crash, and the only thing you can do is think in terms of opportunities. In other words, if valuations are rising sharply, and there's a lot of future hype and people are in a euphoric state, then the likelihood of a correction happening is probably more plausible. But plausible doesn't mean 100% certain. So what you can do is, of course, build up your position, and sell, take some sales to lock in your profits. A little example, false. A long time ago, I sold the Vanex Semiconductor ETF in April 2024, and I actually sold it after holding it for a long time with significant profits. But in hindsight, you could say it was a good move. I'll show you a little example. So the sale was in April 2024. That's actually this date here. And I actually sold way too early in hindsight. Because look, after that, it rose by about 27% return. And that in just about 3 months. So basically, I missed out on that 27% return because of that. After a long wait, now almost a year later, and a year is quite a bit. A year on this little chart seems like nothing, but waiting a year feels long. And just imagine if you have to wait for 5 years. In any case, after a year of waiting, it's now at a missed return of about 3 to 4%. The question is whether it will continue to drop from this level. What we see now is that, of course, we already know that the valuation is very high. The price-earnings ratio of the VanEck Semiconductor ETF, for example, is above 40, with a very large position in NVIDIA. If NVIDIA drops significantly, this ETF will also drop significantly. That's the risk of concentrated thematic ETFs. And what we see is the trend with a lot of ETFs is that the current price is breaking through the EMA 20, which is the red line here, and also the EMA 50, which is this orange line here. When you see that in combination with, for example, the MACD and the stochastics, it often indicates a declining trend. Should you base all your money on technical analysis? I personally wouldn't do that. I really only look at fundamental analysis, but sometimes it does help to look at technical analysis. Why? There are millions of people playing this game, technical analysis. And if you're a long-term investor, you have to take into account other people's game, namely the short-term investors, and short-term investors look at these kinds of charts. And they do make choices based on these charts. So completely ignoring it is, I think, just really foolish. You should always be open to other disciplines, to other ways of thinking, and benefit from that. An example is that these ETFs are all entering a declining trend, and many traders and swing traders, millions of people, are seeing this. You have robots and algorithms, and you have hedge fund managers, and they're all looking at the same charts. And what do you think happens when people react en masse to this? It's naturally a snowball effect. Everyone knows that the market is at a high valuation. So the chance that it will decline is likely. At the moment, I'll show you which ETF I currently have in my portfolio, and also which ETFs might be interesting for the upcoming period and for the longer term. But before we do that, first a little update. Every month, we share an update of our portfolio. Subscribe if you want to stay updated. Recently, you can see that I now have a huge cash position. So the balance is 200K, but 25% of that is in cash position. And it's not so much about the money, but it's about the percentages. Whether you have a lot or a little, it's all about the percentages. That's the most important thing. What happened? Well, I had made big profits on the Ploving and on Hims and Hers, and both were sold after a stop loss was triggered. And that profit was taken, and it still remains in my cash reserve. And I'm not in a hurry to fully dive in. The same amount from my other account, about 70K, is in cash. That's about 55% of the total portfolio. That's quite a lot. And I also have some more cash on hand. But that's for later, only to be shown when I actually start investing, of course. I'm waiting for the market to drop a bit further, and then I will basically buy one ETF that is somewhat comparable, at least in theme, to the ETF I currently have. Because in the last update I gave about my ETF portfolio, I mentioned taking a larger position in the China ETF for internet stocks. Alibaba, Tencent, those kinds of companies are in the Crane Shares China Internet ETF. And I had this position for a long time, but in the past 2 years, because I initially bought an edition, but then kept buying more and more recently, because it looks better in the last period. I think it's a lot better than the American companies. And the China Internet ETF is actually very similar to the Invesco QQQ. The difference is this is a very concentrated ETF, and you can see the position is building up. I won't claim that this is a great choice, but I think we'll see in the long run that it's still possible to achieve attractive returns from this level. But to be honest, I'm basically just waiting for one ETF, and that's the Invesco QQQ. I've had it in my portfolio for a long time, but I also sold a bit around the summer of 2024, gradually reducing my position. And that's what you can do when valuations keep rising. It's actually wise to take a little profit every now and then. I completely stepped out, and you could say, yeah, that's nice to hear, but you timed the market and missed, for example, a 10% return, just to name something. But that's all in hindsight. It's easy to talk like that. What it comes down to is that when valuations rise, the downside potential likely increases. It's that simple. And the Invesco QQQ, for example, currently has a price to earnings ratio of 40. They also have an exceptionally high retail and equity weighted average, so a higher price to earnings ratio is acceptable, but a price to earnings ratio of 40 is still significantly high, even though these are great companies. So it could keep rising for a while, but it could just as easily go the other way. That's hindsight. In hindsight, you only know how it goes. Recently, this week, a fast week, thanks also to Mr. Trump, it has now dropped by about 8%, 7.5%, and I'm really curious to see if the QQQ can drop further. Historically, we often see, like from 2021 to 2022, that this ETF can drop by about 30 to 40%. Of course, also during the coronavirus crisis, but even before that, comparisons are being made with the dot-com crisis. But of course, today, the situation is that there are great companies here, like Apple and Durkin, and Apple, Nvidia, of course, Amazon.com, also interesting. Tesla, less interesting in terms of valuation. Meta Platforms, interesting. Alphabets. So all kinds of really strong companies that just generate a lot of cash. And during the dot-com crisis, it was Yahoo and, I don't know, many of the promises had, but they weren't generating any cash. It was even a race to see who could throw the most money around just to buy good ones. But yeah, anyone can do that. Any entrepreneur can. But these companies generate a lot of cash. So you definitely want to pay a higher valuation type for that. But a price to earnings ratio of 40 still seems high to me. This is indeed from December 2024. Yes, the price is just a little bit below that level, just a tiny bit. So the price to earnings ratio might have been adjusted slightly downwards, for example, around 38. But still, it's likely that it could drop further. And if that's the case, my strategy is very simple. I already have the Queen's Shares China Internet ETF. And although the position seems a bit larger, it's only 10% of this portfolio. So in terms of percentage, it's really not that much. And when the time is right, I will keep buying more QQQ. So for my personal financial situation, I hope this ETF goes down, but we don't have a crystal ball. So maybe I'll just wait and miss out on opportunities. So in the meantime, I'm investing in stocks that I think are interesting, and maybe I'll get lucky and the QQQ can drop further. This ETF is very interesting. Why? Because simply put, there are just a lot of really good, strong companies in here. The ETF is currently quite concentrated, but it's also cheap at 0.2%. The measure of concentration also indicates additional downside potential, volatility, or in other words, price fluctuations. A lot is focused on technology, but not just technology, as you can see here. And of course, especially focused on the United States. This is a great ETF. I can assure you that very few asset managers beat the Invesco QQQ in the long run. But very few, I don't have a percentage, but maybe 10% will work. Maybe, and I'm not even sure about that. Great ETF, really cheap. Asset managers charge 1%, 2% for management fees. Really expensive. You might as well just invest cheaply in the Invesco QQQ and keep buying more during significant drops. Now I might be a bit too much of a market timer. Who knows? Time will tell. In any case, I have reinvested my money in other companies, such as Aploving, which have done very well. Some portfolios are underperforming, so it's not really market timing. It's more like getting out of the Invesco QQQ and buying other stocks. So basically a shift within the strategy. But when the time comes, I'll start buying Invesco QQQ again. Well, the Questions Internet ETF is also an interesting ETF. So I currently have about 10% in. Please don't follow me. Be smart enough to do what you think is wise. But I think the holdings in this ETF are interesting enough right now. And I don't dare to just invest in Alibaba or just in Tencent. I'd rather have an ETF. Are there 25 in this fund? It's also quite concentrated, but you can also see a travel agency, Trip.com, BD.com, which has seemed very interesting as a stock for a long time. Of course, a logistics company, Baidu, the Chinese Google. All interesting companies, and all of these companies generate a lot of cash and have a relatively cheaper valuation. So you basically have a kind of Chinese version of QQQ, but even cheaper. That's quite applicable for China, of course. And the QEB ETF is a bit more expensive, 0.7% per year in fees. On the other hand, I think the upside potential is quite plausible. Recently, I've gotten in at least more and more. I started building my position. After a big crash in 2022, initially, the ETF was in the red for quite a while. I don't remember exactly, but I think it was down about 20%. I don't remember exactly when I got in. Oh, look at that, down 38%. Even after a drop of, in total, down 80%. So you see, even an ETF can drop a lot. For a long time, I was down 20%, but I kept buying a little more each time, yeah. And if you look at the very short term, the price almost reached this last peak here in a very short time. But if you look at the entry point, I think it has a fundamentally interesting valuation for the weighted average of these companies, which are all strong companies. And China itself is currently in a bit of a dip, you could say, but China is and remains a superpower. And you'll be amazed when you look into how much political power China really has. For example, a lot in Africa, where there are, of course, a lot of raw materials right now, and China itself has a lot of raw materials. I'm really curious about how that stands. So, why the Chinese Internet ETF? Because there are a lot of Chinese ETFs, but I find the Chinese Internet ETF interesting because it suits me. I'm someone who likes to invest in technology and growth. So, for me, I find this ETF interesting enough. There will also be other Chinese Internet ETFs, and there will be other Chinese ETFs with much more diversification. So, definitely take a look at those as well. And just so you know, I'm only investing 10% in this, and that's my personal choice. It can turn out well or badly, but I think from this level, it's just a matter of time before it starts to rise again. Because finally, there are a few other things that interest me. Finally, here are a few other interesting ETFs that I'm currently keeping an eye on. I am, but I don't personally intend to buy. The first one, I've mentioned several times, is the Argentina ETF. And I personally had a number of Argentine holdings in 2024, including Pampa, Energia, Cepu, and also Cresut. And unfortunately, I sold too early. I also had IPF for a while. Unfortunately, I sold too early, but it was serious. Achieved high returns of over 200%, and that is all. You'll see that reflected in other videos from the past few months on our channel. The Argentine ETF has risen a lot in the past year. It has doubled just since 2023. In the year 2024 up to today, it's up 75% at its peak, and occasionally it's starting to decline. Now, this doesn't look very good in terms of technical analysis. You can see that the MACD is crossing downwards. The momentum is decreasing. The outer color red says enough. The suggestion is also starting to decline, and you can see that the price might break through that EMA 20. So it doesn't look very good in terms of technical analysis in the short term, but maybe a buying moment could arise when it continues to decline. But the end is that ETF in short. The costs are on the higher side at 0.6%, but the number of holdings is interesting. It's a concentrated theme. ETF, the biggest increase may have already happened. That's clear, and it has to do with macroeconomic developments. A kind of Trump, but maybe a bit smarter. And then we look at the number of holdings, 25, of which the largest is in Meli, and that is Mercado Libre. Meli is the ticker. More than 20% holdings in there. And you see here, IPF Bank Macro also had that for a while, by the way. Pampa Energy and a few others. Oh, I've had that too. 6%, a return in a short time. But unfortunately, it was bought by a Dutch company Process. So the Argentina ETF is interesting. Another ETF that is interesting is the Defense ETF. Moreover, these just happen to all be Global X ETFs, but that has nothing to do with Global X at all. It's simply because Global X shows the price to earnings on the website. And as we see in, for example, Argentina, we see the price to earnings of 21, and then it's estimated price to earnings of 20. Well, that's not exactly cheap, but it can definitely be much more expensive. As you can see with the S&P 500, well, the Defense ETF, it has a very strong momentum at the moment. For example, we also see the VanEck Defense as an example, another ETF, but they all move a bit the same. Also risen enormously lately, especially, of course, due to news from Europe, where they are going to invest. I missed this trend, and it is a trend. I personally have no affinity for defense, but that's beside the point. But that return on equity of 16% is okay in relation to the price to earnings. Next year, it's estimated to be 21. It definitely has strong momentum. The question is, of course, what will happen with all the budgets that are increasing? Just a little warning from my side. Palantir 9% add holdings in this ETF. Well, Palantir is a very strange stock. I talked about it a while ago that it had dropped by 30%, then I wouldn't be surprised. The holdings are 37. So yes, it can be interesting if you're a thematic ETF investor based on momentum and trends. Another one that doesn't have such good momentum but still performs strongly is the Greece ETF. Greece's ETF is with the ticker GREC, or the ticker GRE. And with this ETF, I think, how did you come up with this one again? Greece. Sunny, well, nice and warm. But the number of holdings, that provides a bit of diversification. But that might not be the most interesting thing to mention. What it's about is that these holdings are all weighted together. Average, actually, they're very cheap. The price to earnings ratio is just 7.6 for next year. And the price to book, the ratio is 1. And where do you still find this kind of thing? Price to earnings? You can hardly find that anywhere anymore except in energy. And in Greece, those are all names, especially financial companies that are in this ETF. And yes, it's a slowly moving ETF, not much volatility. And you also have to wondering how stable it all is. We all know about the crash from Greece, a kind of financial crash. So no one knows how stable it is. Look at the long-term trend. Then it still has a long way to go on the way up. At the moment, the market remains relatively strong, while, for example, technology stocks and growth stocks might be struggling. And this ETF with a low price to earnings ratio, especially finance related, could surprise us. Slowly, but surely might be the word. But everything but slow, and that's the last ETF that might be interesting for this year. It's the Uranium ETF. There are different tickers. Ure. We can also look at Uran and a package from Sprott, Uranium Miners ETF, and they have all dropped a lot by as much as 40% or even. So why could it be interesting? Uranium ETF has gained a lot of attention recently because, of course, data centers and large companies that are going to invest in uranium because it is still a source of energy, and energy is now very much necessary for the future. But for some reason, it has dropped a lot. And this is, by the way, the Uranium Miners ETF. But this base ticker, YURE, has a different kind of holdings. Like Cameco, for example, that's one of the largest, of course, but also Oklo. When you talk about specific stocks, but okay, and a bit more. And you can see that it has dropped significantly. So why is that interesting? Well, not at all right now. But maybe it will find a support line here at this level. That's quite a significant drop, about 10%. Then it comes to a price of around 30. It could be interesting for the speculative investor. I would be very careful about how much money you invest in it. Par's earnings also seems a bit on the high side for next year. I have to say, by the end of this year, speculative, yes, definitely. But maybe because the upside potential could be quite large again, by about 80%. You never know how it will go as the data centers keep coming. Energy is needed. Uranium turns out to be the solution for that. But hey, I'm no expert in it, so it will be just a moment. This is about a number of interesting ETFs. Argentina, the defense sector, Greece, a completely different type of ETF. You could call it a value ETF. Uranium ETF, ADO, speculative cyclical ETF. And personally, I would go for what I've indicated for the Crane shares, China Internet ETF. I already have that one. And I'm simply waiting for the QQQ to drop. I'm optimistic when it comes to growth investing and technology. The only thing is that I think that with a lot of patience, there might be a chance that the Invesco QQ becomes available at a lower price. We're buying great ETFs for the long term, and that's what I'm waiting for. I'm happy to learn. I'm curious about what you think about ETF investing, and if you see any interesting ETFs, let me know. What are you thanking for? And until next time.